to talk about the 2026 IPO market, which was a much more interesting topic, I think, 6 weeks ago when we first started talking about this, given some of the events both affecting capital markets broadly as a result of AI and geopolitical matters. But here we are, and so let's kind of jump right into it, which is how would you characterize the IPO market for 2026 as of this particular moment in time?
I'll jump in. Listen, I think it's very selective. So that's probably the word that I'd use for this year. And when we, to your point, kicked off, 2026, we had many software, many fintech IPOs in our pipeline that were very much excited to see the market reopen for them after a really tough 24, a really tough 25. We only saw 23 tech IPOs last year. The year prior in 24, only 10 tech IPOs. And so it's definitely been a gradual reopening. This year was off to a good start in the beginning. We saw 3 tech IPOs get out, but now it's been a lot more selective by subsector. So we're seeing a lot of pull forward of anything data center related, infrastructure, industrials, energy. We've seen healthcare get some good receptivity. And some of those deals have traded quite well. Solve Energy is up 30%. Once Upon a Farm, a consumer name, up 30% as well. And some across the healthcare landscape, up almost 100%. It's been definitely a tale of two cities on the tech side. And it's quite difficult in this environment to bring anything software related at a reasonable valuation right now. And so we've definitely got a lot of companies sort of waiting. We're pushing back, right, those potential approaches to the market to the second half. But again, continuing to monitor things real time.
And there continues to be a bifurcation between AI winners and AI losers. And I think that's the challenge that software currently has. People just haven't figured out where a number of these businesses, and it's a lot of been baby out with the bathwater, right? In terms of there's still a phenomenal amount of great software businesses, but the market just hasn't figured out, as you think about that durability of those kind of terminal cash flows, where this sits. And so people have been forced to focus on more of the kind of the picks and shovels, the AI winners, where we know that anything that's related to data centers, power, chips, semis has really come into favor. And we're working on a number of those situations at the moment. And then there's the second bucket, which is kind of I'll call them megacorns, right? And they are, you've seen kind of rumored around the big LLMs and some of these companies that need a lot of capital. And the public markets, despite them having very successful raises in the private markets, potentially are a way for them to get the breadth and depth of capital that they haven't been able to access. So I think those companies are also the potential companies we'll see this year, and those that are related to kind of the AI winners. And now I'm focusing more on tech within that broader universe.
Yeah, and I'd maybe just add to that just broadly as we're seeing in the markets, right? This is a bit more over the last few weeks is a consolidation versus a capitulation. And what we mean by that is investors as a whole, especially in the public equity markets, they will reassess, they will recalibrate, and they will reallocate. And that's really the sign of good price discovery in an efficient market. And so we're seeing the pains of that now. And historically, as we look at the trends in these geopolitical situations, it does take about a quarter for these to work through the system. Now, again, there's always different variables. And we see that with the potential with the increase in oil prices. Again, if we look at the future markets, a quarter out, it's already at $70. So there's a bullish sentiment there that this gets resolved sooner than later. But that said, right, the stagflation or the inflation element could be another variable that could prolong this. But it does seem like as we survey a lot of the buy side, and Emma, I'd love your take on this as well, but there is deployable capital. There's just a bit of this reset and the reorientation. But again, I think as you heard here, a great backlog of good companies that are waiting for that window to start to peak open. And then I think we'll have a strong Q2 is our prediction.
Yeah. I think the only thing that I can add is I think one of the things that we've observed in 2026 relative to 24 and 25 was a lot less retail participation. I think we've seen a lot more retail participation in markets of 24, 25. I think thematic like space or crypto have attracted a lot of retail participation. So does names like Figma, for example, who have seen kind of going up 250%, I think, on the first day of trading. I think we will have to see how that pans out for the second half of 2026. I think there's definitely a lot of excitement about jumbo IPOs. I think there's probably not a single week where we're not getting inquiries from the press about what we are thinking about the SpaceX IPO coming up. I think to Carly's point, our view is that market will be selective and high quality names, like some of the ones that we are hoping to see in the second half, might be bringing a lot more excitement for companies going public. So I think we'll continue to watch closely on that.
Yeah, one of the things you just mentioned that I'm now already deviating from the script we talked about, but you talked about retail participation, which is interesting because certainly on some of the offerings that I worked on last year, or some of the ones I'm working on with clients now, I'm seeing push and pull on clients who may be very interested in allocating more to retail, and then the banks that are pushing back on that in some respects and wanting to get more into the hands of long only or hedge or otherwise. And as the power of retail has been so strong, you're seeing the companies and the CEOs saying, well, I want to get the hands into that, largely because they're thinking it's going to drive price. And so curious, because you opened the door, how do you think about, how does this group think about retail allocation and offerings?
I think on my side, it really depends on the company. I think some companies are a little bit more suited for retail participation. I think it is expected when you're looking into an IPO like SpaceX, for example, that you're going to probably see a lot of retail participation in that. I think ultimately you want to have a great mix of the two. I think this is the right answer. Yep. And then I think being able to early on start to tell a very compelling story to be able to get participation more broadly from both groups is probably the right way forward.
Yeah, I agree. I think democratizing the IPO process has been a theme for a while, and you have seen some of that just exactly as Emma mentioned, the types of companies where this makes more sense. I think it's also, look, there are a number of platforms online and others that kind of allow you to access this user base. And if you think about a lot of the companies, and you've seen some of the really big tens of billions that have been raised privately, a lot of that differentiator can come through retail now and allowing retail to participate in this. So not all retail is created equal. You've got to think about kind of how you think about the day traders and the people that are putting into this kind of self-managed 401ks, et cetera, and really think about this investments. And it is a smart and useful retail group that can help these companies as they go out, and kind of you're now allowing participation to a much broader audience than has previously been kind of allocated to. So I agree. I think it's selective. I think it's a really helpful group, and I think that trend will continue where it's no longer the single digits allocation to retail, which was often the case. You'll see that to continue to push up.
You know, the price discovery process, though, for an IPO is usually with institutional funds that have spent a lot of time diligencing the story, many testing the waters meetings. It's really hard to sort of access that retail base individually, understand what their price limits are. So they're typically a price taker. And so a lot of the dialogue around the correct pricing for an IPO definitely happens with the institutions. So again, to Charlie's point, historically, IPOs have really been allocated 90% plus institutional, 10% or less retail, except for some of these, interesting more consumer brands or, where there is a very large sort of, following on some of the more democratized platforms for accessing stock. But again, when it comes to price discovery, institutions very much drive that discussion.
Yeah. Now, so as we look about 26, right, there's a few factors that I think we've all been seeing impacting the possibility of offerings. One of them, going back to 2025, has been the hangover maybe of the IPOs in 2025. And I've seen charts from a variety of banks, including some of your colleagues, that shows the price of offerings from 2025 for technology offerings, first day price, and then current trading price, and there was a lot of red on the board. And that certainly I was starting to hear and see pushback once we got into December and early January on the appetite for tech IPOs in light of some of the offerings from last year, which in the perception that maybe not trading well. And so how do you think, even before we get to AI and geopolitical, how do you think about last year's performance and how that impacts the current crop of companies seeking to go out?
Yeah, go ahead.
No, I was going to say, Charlie, you want to?
Look, I think if you actually look and you dive into each of them, there's idiosyncratic reasons why that happened. A lot of them, and I think this comes down to just kind of broader planning as you think about just kind of how taking out your companies if you're a founder and or if you're kind of a key shareholder within them, is a lot of them missed on earnings, to be honest with you. There was some footfalls when you came out of the door with respect to kind of how you performed. And it's really, really important that your company's set up for a beat and raise. That's what the public markets want from you. They want you to come out, they want you to deliver on your earnings and start to develop that track record. There's reasons why public companies continue to push up and to the right that have been out here for 15 years. They don't need to be growing at 30% every single quarter. It's they continue to grow and deliver and beat on that performance. If a public company comes out and in their first foray as a public company misses on any of these metrics, it sets them up for a really challenging life. And if you actually dive into a lot of these companies, now some of them actually were able to perform and there were other reasons for that, be it broader macro comps, etc. But a lot of these companies unfortunately had some kind of like footfalls in there when you dive through and set them up where investors were looking to allocate their capital elsewhere because you're a new management team. You're not yet trusted. The market doesn't know how you perform. You've got to set yourself up for success with respect to kind of underlying financial and operational performance. And that's how investors will continue to believe in you and buy and push your share price up. And so if you dive in and you actually kind of look through this, a lot of it was based on, unfortunately, some kind of challenges with performance in certain areas. Now, a lot of that's macro driven, a lot of that's kind of AI. There's all sorts of external factors, but kind of the companies that continue to have really strong underlying performance have performed well.
Yeah. And to put some numbers around it, the sort of offer to current for the aftermarket performance for tech IPOs last year, it's down around 25%. For tech IPOs this year, it's down, again, around 20%. But you put that in the context of how have software names, the broader tech space, traded as well. You look at the vertical SaaS companies year over year, they're down about 20%. Horizontal SaaS, down around 45%. Yeah. So there's the missing out of the gate. So definitely get the model right for beat and raise when you disperse that to research analysts. But also the broader macro has been incredibly difficult. But IPOs are an even riskier asset class than just publicly traded companies, of course. And so there's even a higher risk premium attached to staying in those names versus finding some safety elsewhere.
So there's been some references to software. Is the software IPO still a thing? Or I mean, we've all watched as AI, every new advancement from one of the big labs has had a really negative impact on long-performing software companies that are beating and raising, and they're losing significant percentages of their market cap. And so how should we think about a software company trying to go out in the current environment?
Yeah, I'd say I think for the next cohorts, and again, there's a little this chicken egg, who's going to be first in that software space. My sense is we'll see more of those private equity backed, I think as you mentioned, kind of the slower growth, but scaled revenue, profitable, understandable business, more of a moat. I mean, there's obviously the AI component to that. But I think those will be the profile of companies that we'll see come to market potentially in later Q2. And then I think broadly as they look at the comps, again, to that point, specifically some on the horizontal side, but also specifically on the vertical side, there's this notion that you can vibe code another Salesforce, right? And I think that's been refuted quite a bit publicly, that there are 20 years of debugging that, the software itself, let alone the data and the ledger that is for so many enterprises, that's not necessarily going to get disrupted by an individual doing it themselves. So I think there's a lot of staying power for these large incumbents And I think we'll continue to see that for some of the larger scaled private companies that'll be coming to market sooner than later.
I think one of the things that remains a question is, what is the AI strategy for the software company? I think not all software is equal. So I think just making sure that if you are planning on going public, you've spent plenty of time with public investors like T. Rowe, like others, before your quiet period on telling that narrative as to how you were embracing AI and how you were partnering with other players and how ultimately it is a tailwind for what your business is doing. I think it's probably one. Second, I think the performance of that company. I mean, if you've been seeing growth declining every year and then ultimately a lot of your business is taken away by some of the AI winners, it's a little bit tougher. But if you are able to constantly demonstrate new growth, get a couple of these AI native companies as your customers and demonstrate how this is a tailwind, I think it is very compelling. I think the third component is, how are you positioning yourself for that IPO? I do think that, yes, we're going to see some reopening of the IPO market, but macro is difficult at the moment and very hard to predict. I think we've seen it with the situation in Iran. I think, even if we were to get a resolution over there, it is not super clear at this point in time how macro could potentially be impacting more broadly the IPO market. And then with all of these jumbo IPOs that are planning on coming, how do you time it? Do you try to go ahead? Do you try to go after? I think these are maybe just bigger questions versus just, is it a software company or not, in terms of whether or not it will ultimately be successful.
Yeah.
So you hit on that point on geopolitical and the current situation. Do we think that the market is going to be shut until that can resolve itself for however long that may last? Or do we think that companies will be able to go out in the face of the current uncertainty?
We have an IPO that's scheduled to price over the next 24 hours, so we're going to see how that goes. It's about $1 billion IPO across the fintech space. There's a lot going on in the public company raising additional capital, so follow-ons and converts that are coming now. So I think the window is, again, open, but it's selective. I think, again, the software IPO window is very challenged right now, given what we've seen in that specific subsector. But again, a lot of companies are navigating sort of this geopolitical window and volatility, currently.
Yeah, and the market just moves incredibly fast in the world that we live in now. And so I think they've absorbed a lot of this. And exactly, if you're able to have, we've seen a lot of convertible issuance for companies that are kind of exposed to the broader energy sector, because they've been able to take advantage of these prices. And we've done deals already that kind of over the last week, which have been multiple times oversubscribed, and there's been a lot of demand. And so I think the market is open, and I think this is going to be the theme of this year is Windows-based selection. The question around how you time with respect to these potential jumbo IPOs is something everyone's asking. How do you bring out a $3 billion company when there's a potentially a $1 trillion company before or after? And how do you ensure that you get the right level of attention and demand? And I think those are the questions that people are asking, just not only around kind of broader geopolitical conflicts, but the market in general, right? The timing and how you sequence this year, I think, is really important. So a lot of our clients, and I'm sure it's the exact same thing with Carly, it's a lot of getting ready, getting through the process, early investor education, right? As Emma said, kind of telling that story, why you're going to be in this AI winner bucket or whatever bucket that you're positioning yourself within, to ensure when there is the window, you can take advantage of it and have that successful IPO. And that's what's happening in the background. A lot of prep, a lot of time with investors, multiple rounds with investors, so you can take advantage of these windows when they're there. Because we do live in an open and shut window. It is open at the moment, and I think it's going to continue to be. And I think it's just going to be taking advantage of kind of the opportune times within that open market.
I did ask a little bit our trading desk on kind of their view a little bit here. And one of the things they were pointing out too is really volatility benchmark. And that's generally a good indicator of appetite for IPO. And I think any numbers that would be kind of below 20 would be a good indicator. And then we're currently sitting at about 25, more or less. So that gives just a general kind of take on where people's heads are at in terms of IPO opening or not.
So there's now in a couple of responses to questions, there's been reference to investor outreach. And obviously, many years ago, they started allowing the opportunity to meet with investors, testing the waters meetings. And then we started doing that. And now, on the offerings I work on, you see maybe 2, 3, multiple rounds of that, non-deal roadshows before you've even orged up. Let's talk a little more about the importance of investor education, both before you're into the process, so you can do the NDR, and then during the process, and thinking around multiple rounds of TTWs, and how important it is in the current environment to really make sure you have investors that understand the story before you ever go on the road.
Yeah. Well, I think one thing that we're seeing in IPOs is there's really three key groups of investors. So there's going to be your long onlys, your hedge funds, and then a higher participation from sovereign wealth funds. So as you think of those 3 buckets and then how vast the firms are in each of those buckets, again, this best practice of starting early, but that can take a lot of time. And obviously you can leverage your advisors and start to tell that story, but it has to be part of that focus. And I think to your question around the importance of it is, for companies, it also gives you that feedback loop. So as you're out testing your story, as you look at your board decks and in that particular model, and then you'll likely have an investor model. I think, as Charlie mentioned, kind of that beat and raise. So it also helps you stress test not only your story, but your KPIs, as well as your model and some of the financials to get that feedback loop with investors, but also eventually the analysts. So as they start to put you in different buckets, and we're seeing a lot of companies that may straddle 2 different buckets that have software as well as hardware, or vertical as well, they plan to go horizontal into other verticals, but how are they comping you, and is that the valuation? Is that where you want to be? As again, you look at where those comps are currently trading in the market.
It's incredibly important. If you want to IPO, you need at least 8 to 12 months at a minimum to prepare. And that is also amongst all the work streams, drafting the S1, making sure governance and board matters is all tight. Investor engagement is a huge one. And we're seeing a lot of private company conferences, a lot of companies make the rounds, particularly with investors that aren't investing in privates, but they're investing in, ready to sort of pull the trigger at the IPO. So again, that constituent is looking for private companies to buy at IPO, as well as sort of the more organized non-deal roadshows, or once you've orged up for your IPO, the testing the waters meetings. And particularly if you're, to Emma's point, trying to navigate a transition from a traditional software company to explaining what your AI strategy is, you probably need even more time than 8 to 12 months for you to validate that with customers, revenue retention, what's the impact on your unit economics and margin structure, are compute costs pulling that margin down? What does that impact look like, so that you can go very clearly amongst multiple quarters as you lead up to the IPO with an improvement in that story and that strategy over time. And one thing that investors will always have is their notebook that they've written what you've said down in the meetings, and we'll go back and refer, did you meet that? Did you beat that? How did you do against what you told me you were going to do last quarter? And the last thing I'll say is that it's a little bit of an interesting sort of thing to navigate is overstaying your welcome on the, hey, we're going to IPO, we expect to IPO in the next couple of years. And if you're on the circuit for 4 years, people start to wonder, do you really ever plan to go? Of course, market conditions play into that, and a lot of companies are in that camp, but it's just something to be mindful of as you think about that timeline ahead of when the target IPO is.
One thing that I'll say, and I'll talk a little bit more from a T. Rowe perspective, I think if you're able to secure capital from a firm like ours when you're still private, that's one of the best way to start the education early, because what that does is that forces us to have you covered internally and to publish internally on all of your performance and follow you on a quarterly basis. So when you're getting much closer to the public offering, you're not having someone completely new that's never heard about the company that is asked whether or not they want to take coverage. They might be too busy with other things. And then there you go and you want to do your NDR, but then not a lot of people are available, or you don't have formal coverage, and then that doesn't translate very well in terms of your book building when you get to the IPO. So the earliest you can start to actually take capital from firms like ours, get you covered by the person that's going to cover you once you are public, I think the more likely you are to be successful on your IPO process and during the roadshow. The other thing I think is important to mention is that public investors tends to be quite brutal once you are public. If you are beating your numbers by very little, and then ultimately the price is high, this won't be perceived by public investor as a true beat, and people can very quickly kind of switch sides. And I think this is very different from being on the private side, where we all get very excited for any form of beats. So if you've been educating and being alongside that person for a very long time, and on one quarter post going public, you don't have a meaningful beat, investors are more likely to stay with you because they know you, they know the story, and they know it's temporary. If they've just gotten to know you 3 months ahead of that and they're not happy, I think they can switch side fairly quickly. So I think it's another reason why starting that process early and building that relationship early is really important, I think, in terms of not only the IPO, but the post-IPO performance.
So, and Michael, as you listen to all of that, it comes down to de-risking, right? As exactly what kind of Emma was running through, Cardi was running through. The early education, you have 7 days on the road for a roadshow. Everything you do before is to de-risk, to ensure that when you come to the main event, that you get the best outcome. And so that is why we're continuing to see it. And it brings back to the earlier point. When you have through all that early education, you've de-risked. When you have this open window, you feel confident in taking it to get the best performance.
And there was talk about metrics and obviously controlling the whisper number and making sure the street doesn't run away from you and what you're guiding to. But taking a step up, how should we think about metrics at all in the current environment? What are the key metrics, right? There's been a lot of talk about revenue you have to be at, and we can set aside the mega companies, but for your normal company, right, is the rule of 40 still a thing, right? How should we think about the key metrics that companies should be thinking about and trying to determine if they're a public company ready story?
Yeah, we still hear from investors and guide our clients that rule of 40 is absolutely still relevant. I think it's a little bit harder in a true AI native story to be like, yes, that is absolutely, there's more to it, there's more qualitative to it, margin structure, durability of revenues, that are, defensibility of moat that are coming into place. So it's qualitative, but definitely rule of 40. And growth is still very much prized within that balance of growth and profitability. So the companies that are rule of 40 plus in the public markets are, if you're more than half of that rule of 40, so more than 20% growth, you are trading at a 3 times premium to companies that are more profitability focused within that rule of 40. And so that you've got a 14 times revenue multiple for Rule of 40 companies that are growth focused, and you've got a 4 times multiple for Rule of 40 companies that are profit focused. So it is very much still a growth oriented market. You don't need profitability at the time of IPO, you just need a credible path to profitability that you can talk through how you're going to achieve that, and what are the quarter by quarter ways to get there. But it is still very much a metric that investors will look at, and again, like, growth is still really important, particularly for this asset class of IPOs.
Yeah, I think we still look at Rule of 40, and it really depends on what the company, what sector they're in, and there will be difference, of course. But Rule of 40 is still something that we look at, and I think what I would say, it's always kind of a function of what kind of markets we are in. I think when we are in a down market, it's a lot more emphasis on the profitability, free cash flow. When we are in a market that is a bit more on the bull side, of course, there's a lot more attention that is put onto the actual growth of the company. I think right now we are still a little bit more towards growth versus profitability, but we do look at both, and they're both key metrics for us in terms of assessing potential for a company.
Yeah, I mean, I'm not going to pile on. I think investors absolutely do. Growth is still favored. And I think the challenge, though, becomes, if you think about Rule of 40 and where that's used for, this AI narrative where people struggle, even if you have a great rule of X, whatever that number is, how durable is that growth is the challenge that we've seen in the market. And I think it's going to continue to be the question that's asked until you can prove out some of your stories with respect to this kind of AI tailwind and or headwind. And that's what people are asking. That's why you see great companies that do sometimes have phenomenal growth and not being rewarded as well, because everyone's focused on what does that look like 5 years from now. And that can be a really challenging story to tell, as I think no one really knows what that looks like at this juncture. People have an idea, and there's a little bit of waiting for that to be proved through. And I think we'll continue to see a little bit of that for the foreseeable future until investors have a better line of sight to kind of where this shakes out.
One of the things that I think I hadn't seen for an extended period of time was kind of a dual track processes being relatively prevalent. Largely, I think, because 2020, 21, everyone wanted to go public because it was the go-go days. And then there were no IPOs, so everyone was selling. And now I'm seeing more companies that want to explore kind of a more traditional dual track process where maybe we'll go public, but that's not necessarily the end result, and maybe we'll sell the company. Are you seeing kind of dual track processes back? How are you thinking about advising companies if they're exploring that? Things for the folks to be mindful of when considering whether a dual track process is right?
Triple track.
Yeah.
Triple track. Sale, IPO, or private/continuation vehicle. And they're all on the table right now. And it is absolutely worth exploring all three. I was actually just sitting earlier talking about, these people on the board think that the company can't IPO. These people think, it can't sell. So we got to explore all options. And that is absolutely what we're seeing in this market right now.
Yeah, we're seeing the same thing. I think, look, there's very few companies that shouldn't be considering this, right? Because I do think optionality is absolutely something that everyone should be considering. If you're a company that's going to be of size where no one can really take you out from either kind of a financing perspective and or competitors, then look, you can maybe put the one M&A path to the side. But I agree, this continuation, private capital, thinking about kind of how you can stay private for longer and just fund yourself, or the IPO becomes potentially the new usual track for a lot of these businesses, right? And so I agree, this is the triple track is often kind of what you've got to consider just to preserve optionality.
You mentioned the third kind of leg of that stool, staying private longer. Obviously, companies are staying private longer than ever, raising significant amounts of capital as a private company. Why is that? And do you think that's going to continue the trend? Obviously, there's the rumor of the three big ones going public later. Does that break the dam? Or are there going to be companies, Stripe is a famous example, where they don't want to go public, and there will be companies that can do RSUs as a private company and are going to stay private.
Yeah, I think from my vantage point, I think what you're seeing, and we've discussed this, I think, over the last few years as well, and Carly, this is a bit of your world, but not only is the private capital available, but then two, in the efficiency of the private markets, you're able to run these secondary programs. Yep. So liquidity was a key driver for a lot of shareholders and companies to go public. And a variety of attributes of being a public company, but that being one, especially as we think of that fight to attract and retain that talent. And so now we're seeing over the last few years, and again, it's directly correlated to kind of the risk on, risk off in the broader markets, but we're seeing an increased volume and a smaller spread in discounts for those private companies that are having almost now a cadence of twice a year where they're running either a buyback or a tender offer, or even in some instances, an auction. So they're allowing their shareholders, or specifically their employees, to have some of that liquidity. So therefore, they're still, they're retaining that talent there, especially on the technology side.
Nasdaq has a tool for that, right?
We do. We have the Nasdaq Private Market. We do. So anybody has questions on that, happy to help educate, especially on the trends we're seeing around that particular market, right, on where things are trading in the markets.
I don't think Stripe is going public anytime soon, so probably this is an exception to the rule, but I do think a lot of the large companies where we've seen them delaying IPO for multiple years still have the ambition to be public companies one day. I think the likes of Databricks is a company that will go public. I think the likes of Canva is another very good example that I think still have that ambitions to be public companies, Revolut and more. So I do not think that we are in a market where remaining private forever has become an option. And I think probably the more interesting example is SpaceX. I thought probably all of our people internally at the firm were thinking that this company would never, ever think about the public markets. But ultimately, as we can see and as we all saw, even some of those are starting to think at the right point in time about going public and the benefits of doing so.
How, we've seen some, I've talked to lots of founders about more exotic dual class structures recently. And everyone seems to one up, and now we've got golden share issues like Toby at Shopify or Palantir owning 49.9%. How do you think about dual class? It used to be 10-to-1, and it was kind of very vanilla, and now we're seeing all sorts of puts and takes on these. And how does that kind of impact the ability to both sell the IPO and market it to investors?
And from my perspective, I think that it depends where, so there's always kind of setting new precedents, which always makes things more challenging, but I think there's a wide range of precedents. It is one of many things that investors will consider, and I think that's going to be important. If you're going to push on price, you're going to push on dual class, if you're going to push with respect to kind of all aspects, it can make your IPO more challenging, right? Because there are other areas to go look at and invest in. And there's always N of ones that have the ability to do that and deliver the optimal outcome. But I think it just kind of is one of the tools that you need to kind of think about with respect to kind of what are your priorities and line that up, and then assign kind of how you're going to play those priorities versus kind of what are your overall objectives and where investors are. And that's how I think about that. We haven't seen the market completely tested with respect to this in this environment. People are talking about different types of structures. That's the same with lockups. There's all sorts of different structures. I think it's just how you then kind of outline that with your priorities, and that's where investors will line up. And ultimately there's often a price for everything, right, in the public markets. And so that's where it'll line up, is kind of where does that get you with respect to your price, and how does that compare to your priorities?
Yeah, I think ultimately you always want the best investment. You want perfect governance. You want very high growth. You want profitability. Most of the time, you don't get an ideal world. And I think if you're looking into some of the best performing companies, a lot of them have been founder-led and founder-controlled. And we've been very successful with some of our investments in founder-control and founder-led businesses. And ultimately, I think the decision to invest or not invest in one of these case scenario comes back to your belief in management's ability to execute. I think it also comes down to whether or not you feel you're aligned with the management team in some of those companies. And if they are coming to the public markets and they've been leading the company since the start, they also got the company there. Yep. So if you have continuous belief on their vision, I do not think that the fact that they control a majority of the shares should be an obstacle for an investment. I do think that going public does help in providing more transparency. I think there's probably a lot of other things that we are adding. So we're probably adding a lot of independent on the board. You have audit chair and all of this, which improves the governance. And that is all things that we like. But I think one of these provisions wouldn't prevent us from investing if we believed on what the founder is building and the overall management team's ability to execute.
Great. Well, we're out of time, but I'm going to ask the one last question for each of you is, of SpaceX, OpenAI, and Anthropic, how many of them go public this year?
Ooh.
1.5.
Yeah. I'm going to be bullish. I'm going to say 2.
I'm going to go with 1.
I'm going to go with 2.
Okay. Well, there we go. Well, thank you very much for the time, and thank you to my panelists.
Thank you.